Okay, so that was a good overview session. Now here we are in the first chapter. This chapter is called Accounting for Business, and what this chapter is it shows you the basics of accounting. It's the foundation of accounting, um, and so that's what we're going to learn in this chapter. Be relatively quick and easy. I'm going to show you the different types of users of information, of accounting information, who uses it, why we use it, how do we interpret it, that kind of thing. So, uh, this is a very simplified way of looking at accounting and what accounting really is. Accounting is based off of transactions. Transactions occur from the exchange of goods and services for cash or whatever, right? Think about the last time you went shopping. You purchased an article of clothing, or maybe it was you went to the grocery store, or whatever. You went on Amazon, whatever. You purchased something. In that purchase, there was an exchange. Two things happened. You purchased a product, received the product, and you paid cash. Okay, that's a transaction. All right. So in accounting, the first thing we do is we identify when a transaction has occurred. What date did it happen? What was the amount? And what were the two accounts that were affected during that transaction? Then we record the transaction in what we call a general journal. It's a log of transactions. Yeah. And so we record the transaction in this general journal where we identify the two accounts that have been affected. So the earlier example I gave is you went shopping at Macy's, you purchased an article of clothing for $100. Okay. So what happened? You received the clothing from Macy's and you paid cash. What happened on the Macy's side of that transaction? Okay, that's what I want to teach you. So what the way Macy's records that transaction is they're receiving cash from you, the customer, okay, and they're giving you the inventory that you purchased. Okay, so that's two transactions being affected here. I'm receiving cash and I'm giving you inventory, right, or merchandise. So I'm going to debit cash because it's cash coming into the business, and I'm going to credit cost. I'm going to credit sales. I'm going to credit sales. Okay, sales represents the cash received from the customer from the sale of the inventory. Okay. In that debit and credit, that's what we call impacting an account. I debit an account, I credit an account. We call it double entry accounting. Double entry because there's two accounts being affected. I got cash coming in, so I debit the cash. I made a sale, so I credit sales. That helps me recognize my sales revenue. That's what we call recording a transaction. And then I communicate that transaction or a series of transactions to my management team to help them to make decisions. Yeah. So that's the process. That's the process of accounting. And that's why it's important to understand how accounting works. There's really two types of users of accounting. We have internal users and external users. As a few of you had mentioned in the introductions, accounting is the language of business, right? That's the definition of accounting. It's the language of business. Helps us to communicate financial information to decision makers. Okay? Decision makers can be either external users or internal users. Think of the company. External to the company are people outside of the company: shareholders, lenders, auditors, non-management employees, regulators, etc. There's customers, people outside the company. Then we have internal users of financial data. These are people working inside the company, purchasing department, human resources, production, research and development, marketing. I could keep going, right? There's a lot of people working for the company that make decisions based off of the financial information. So, two groups of users: external, outside the company; internal, working for the company. As you are probably aware, there's a lot of different types of accountants out there. During the introductions, we found out about couple of different positions, right? So these are just some listings of opportunities within accounting, and it goes beyond all of this stuff. And you can see, financial accounting, managerial accounting, taxation, right? And then accounting related. Accounting related is, kind of accounting. uh, so to kind of break it down a little bit further, um, these types of positions, they're in both public companies, private companies, government, non-for-profit, etc. Okay. Accounting is in every single business on the planet. Okay, that's how businesses track what their profit, their revenue minus expenses equals their profit. And how they track their expenses and how they track their cash flow, etc. So accounting is involved in a lot of different ways that maybe you didn't think about before. In today's day and age, and I know that you've probably heard a lot about artificial intelligence in the news over the past year, and it's only growing. It's the highly fast growing area that is affecting every single person, really. And it even affects us, right? We use artificial intelligence on a day to day basis in accounting and outside of accounting. It helps us to remove redundancy. It helps people to be more efficient. We use data analytics to visualize things like trends, and it's really evolved. It's an evolving space that you need to be aware of. And I strongly encourage you to start experimenting using artificial intelligence, whether it's something like ChatGPT or Bard or one of the other many pieces of artificial intelligence software out there. Experiment with it. Okay. I want you to learn how to use it because at some point in your life, if you plan on working anywhere at any time, you're going to need to know how to use artificial intelligence in some way, shape, or form. Yeah, this is the future. So I want you to start learning this stuff now. Uh, Ethics is at the forefront of everything we do in accounting. We try to make sure that our information is transparent, that we recognize any type of ethical concerns, address them, and make decisions. Okay, ethics is super critical because we need to prevent fraud, fraudulent activities. We need to be able to protect our assets. We need to be able to act in a way that we are doing right by your investors, your customers, your employees, right? So ethics is at the center of everything that we do, especially when you're dealing with money, right? I mean, you got to be ethical. So I'd mentioned fraud. It's really important that we prevent fraud. So in order to prevent it, we got to understand why does it happen. This is called a fraud triangle. And there's really three reasons why fraud occurs. One is that there's an opportunity for it. Some people are opportunistic. They see an opening and they go for it. Some people try to rationalize fraud. They're saying, oh, um everyone does it, that type of stuff. That's rationalizing. Yeah. And then there's pressure to commit fraud. It's like, oh, those bills are coming due. I'm real tight on cash, and I know the company's got some cash, and you know, So these are the three reasons why fraud happens. It's important to know this because we, as managers and accountants and business owners, we need to be able to prevent it from happening. Yeah. So it's important to understand how and why it happens and how to prevent it. Here in the United States, uh, our accounting is governed by what we call the generally accepted accounting principles. This is a set of four primary principles that helps to govern everything we do in accounting. It makes things uniform, very clear, easy to follow. It helps to provide relevant information to decision makers and is in a faithful representation that is both clear, accurate, and of course ethical. So, the generally accepted accounting principles is governed by who we call the Financial Accounting Standards Board, which is here in DC. They are in Chinatown across from the Capital One Arena. Mohammed, I see your hand.
Yeah, so I cannot understand until now what is the GAAP. Just could you explain it again, please, Professor?
Yeah, absolutely. So the generally accepted accounting principles, also known as GAAP, is a set of governing components that help to uniform the way that we conduct accounting. Okay, so and I'm gonna go into more detail about that here shortly. But think of generally accepted accounting principles as uh, a set of principles that we use in business to govern the things that we do in accounting. Okay, like the matching principle, expense recognition principle, revenue recognition principle. These are principles that help us to govern our accounting. Yeah, it makes things uniform, easy to follow. Good question. I'm going to go into more detail on that shortly. Great question.
Thank you.
Yep. So yeah, the Securities Exchange Commission helps to govern these things. They oversee GAAP and they help to provide transparency for investors. We also have what's called the International Accounting Standards Board. They are very similar to the Financial Accounting Standards Board that we have here in the United States. International oversees pretty much all of the other countries, and the Financial Accounting Standards Board is here in the US. The two are very similar. They provide this a very similar set of standards and practices that help to govern accounting. So this is a framework that helps you to understand how accounting works in a very general sense when it comes to recognizing and measuring accounting information. So we look at recognition and measurement as the base of everything we do in accounting. And then of course, there's some elements built in like the financial statements, which are the income statement, balance sheet, statement of cash flows, and statement of retained earnings. We'll talk about those here shortly as well. We look at qualitative information like customer feedback, surveys, etc. And we also identify what the objectives are of the company, whether it's to provide information to investors, creditors, or other individuals. So just think of this as a very general framework. So there are, as I had mentioned, four primary generally accepted accounting principles, and we're going to talk about these. The first is called the measurement principle, also known as the cost principle. Revenue recognition, expense recognition, and full disclosure. These are the uh, four primary generally accepted accounting principles that we're going to talk about. These principles are based off of what we call assumptions. The assumptions are that the business will continue to operate, also known as the going concern. The monetary unit, which was like the US dollar or the British pound or the euro or the peso, whatever, right? The time period, which is represented as a month, a quarter, which is 3 months, semi annual, half a year, or annual, a full year. Those are the four types of time periods. And the business entity. The business entity is, what kind of business is it? Is it a publicly traded company? Is it an LLC, a C Corp, S Corp, or some other type of organization, right? That's what a business entity is. We're going to talk a little bit more in detail, but I just wanted to have you have a general understanding of how generally accepted accounting principles operates. So here are the four primary principles that I had referred to. The first is the measurement principle, also known as the cost principle. This is where we make sure that all of our accounting information is based off of the actual cost. The actual cost. For example, let's say your company recently purchased a piece of machinery. Okay, that machinery cost something. Okay, let's say it cost $1 million to purchase it, the piece of machinery. So the company pays $1 million to buy the machinery. That's not the total cost. Okay, the purchase price is usually not the same as the total cost. The total cost involves the purchase price plus installation plus insurance to get it to you, plus shipping, plus maintenance. Those together equal the total cost, which can be recognized as what we call the actual cost. You see? So that's what the cost principle tells us. The next one is called the revenue recognition principle. The revenue recognition principle tells us when to recognize revenue and at the amount that we expect to receive from the customer. Okay, here's what I mean by this. Timing is very important in accounting. Okay, when it comes to recognizing revenue in business, we don't recognize revenue until the revenue is earned. Earned. Here's what I mean by that. Let's say I sold a calculator to Jenny. Okay, Jenny bought the calculator from me, and I said, "Hey, Jenny, uh, uh, pay me up front, and I'll ship it to you later. Within a couple of days." Okay, when Jenny paid me for the calculator before I shipped it, that's called unearned revenue. Unearned revenue, because I collected cash before I sent the product or provided the service. Okay, that's called unearned revenue. The reason for that is because I didn't earn that revenue until Jenny received the calculator. All right, so earned revenue is when the customer has agreed to pay and you, the business, have provided the good or the service. Once you provide the good or the service, that is when you can recognize revenue. Okay, not when you receive the cash. It's when you've provided the good or the service. That's when you recognize revenue. Okay, otherwise it's called unearned revenue. if the customer pays you before you provide the good or the service, that's called unearned revenue. It becomes earned revenue when you provide the good or the service. You see? So that's why timing is really, really important in accounting because it's not always about cash. It's not always about the cash flow. See? So that's revenue recognition. The next one is called expense recognition principle. This is also known as the matching principle. Okay? The matching principle. The way the matching principle works is that when I record expenses, they have to match when the revenue was reported. Okay, here's what I mean by this. When I sold that calculator to Jenny, I incurred some expense. I shipped it to her. So when I ship the calculator, that's a shipping expense. Okay, I need to record that as an expense. When I shipped the calculator, I recorded the expense. Okay, because that's when I earned the revenue. You see? So in the month of January, well, let's say last week I sold Jenny the calculator, I shipped it in January. I record the expense in January. Okay? In other words, the expense needs to match when the revenue occurred. All right? Here's another example of this. Let's say I sold Jenny a calculator in December. All right? On December 31, I sold the calculator to Jenny. I didn't ship that calculator until January 2nd. Okay? When do I record the shipping expense? I record it when I made the sale to Jenny in December. Okay? So the point is, you need to record the expenses to match when the revenue occurred. Does that make sense? That's what the matching principle means. Good? Okay, you'll notice there's an error on this slide, and this last one should actually read what we call the full disclosure principle. And the full disclosure principle tells us that we need to disclose our financial statements to our decision makers in a timely manner. I need to tell my investors my income statement, balance sheet, statement of cash flow, statement of retained earnings in a timely manner. That's what we call the full disclosure principle. That's what this last one should read. So sorry it doesn't. I don't know what happened there. Assumptions. As I mentioned, there's four primary assumptions in business. One's called the going concern that tells us how long the business should operate. Yeah. Monetary unit is what type of currency is the business in? Is it dollars, US dollars? Is it peso? Is it euro? Is it anything else, right? British pound. Time period, is it a month? Is it a quarter? Half a year, also known as semi-annual, or year? So those are the four time periods. And the business entity, is it sole proprietorship, LLC, partnership, C Corp, S Corp, etc. Yeah, these are the four assumptions. And I do apologize. It looks like we are going to go a little bit over time. If you need to drop off, I totally get that. But I promise we'll try to wrap this up as soon as possible. The other thing I should have mentioned, and I apologize, I didn't mention this. Yeah, Ty, totally get it. Absolutely. You need to drop off, that's fine. I should have mentioned this. So we try not to meet on Thursdays. The reason for that is because I want you to use that class time to complete the work for this week. Yeah. I'm telling you right now that this class gets very heavy. And so the reason for that is because I want you to have that additional class time to focus on the coursework rather than being stressed about this. Yeah. So just want to put that out there. Okay, so these are the four primary types of businesses: sole proprietorship, partnership, corporation, and LLC. Feel free to read through those. It just kind of defines each type of business. Don't stress too much over it, but I just want to let you know that those are the four primary types of businesses.
Quick question. We can find all of this in the book, right?
Oh yeah, absolutely. Yeah, it's in the
Awesome.
book. You got the PowerPoint presentations in the classroom. I'll post the video. All of that stuff is there for you. Absolutely.
Okay.
Yeah, good question. The constraints. So in accounting, there needs to be a mutual benefit. We call this a cost benefit analysis. The cost needs to be disclosed. There's a materiality constraint that tells us, the information that's being disclosed, and also what we call conservatism, which is, industry practices. Nothing to worry too much about, but I just want to let you know what it was. Okay, so here is the absolute basis of accounting. This is what we call the accounting equation. The accounting equation is, and it's just like this. The accounting equation is assets equals liabilities plus equity. Assets equals liabilities plus equity. Assets are what the business owns. Assets is what the business owns. Okay? Assets include things like cash, the business has cash, accounts receivable, that's monies owed to the business from customers that haven't paid yet, inventory, if they carry inventory, uh, property, plant, and equipment, also known as fixed assets. Those are typical things that the business owns. Yeah, we call those assets. Liabilities are things that the business owes. Liabilities are things that the business owes to someone else. Okay? Anytime you owe something to someone else, we call that a liability. Yeah, I got to pay it. I owe it to someone else. It's a liability. An example of that for a business would be things like accounts payable. Those are bills that the company received and has not yet paid. That's called accounts payable. Accounts payable, notes payable, those are loans. And there's a couple of other things like a mortgage payable, long-term loan. Liabilities, anything the company owes to someone else. And equity. Equity is what the owners of the business own. What the owners own. Sounds funny, right? What the owners own. Equity is what the owners own. It represents the ownership of the business. Okay, it's the difference. Equity is the difference between the assets and liabilities. Yeah, that's what equity is. Equity includes things like owner's capital, which are what the owners pay into the business and take out of the business through owner's withdrawals. Owners can take, cash and other things out of the business for personal use. We call that owner's withdrawal. Equity also includes revenue, which are from the sales of products and services to customers, and expenses, which are expenses incurred by the business. Yeah. So that's equity. Assets equals liabilities plus equity is the very basis of the accounting equation. And I'm going to run through a couple of examples of transactions and how these transactions affect the accounting equation. So let's start with the first transaction. Here we have an example. The first transaction is investments made by the owner. The owner of the business put $30,000 of their cash into the business to get the business started in a new partnership, or, I'm sorry, proprietorship. So when the owner puts money into the business, we debit cash to represent cash going into the business. It's an increase in cash. And we credit capital, paid in capital, which increases the equity for the owner. Mohammed, yes.
Excuse me, Professor. I'm so sorry, but I have a class right now.
Yeah, that's fine. Yeah, I understand. No worries.
So,
I'll post the recording.
okay, I know this. And what about the attendance? You recorded me in the attendance
Yep,
already?
I got you.
Okay,
I got
okay.
you. Okay,
Thank you so much, Professor. I
you-
appreciate it.
you're welcome. Have a great day.
Thank you. You too. Thank you so
Thanks. Bye.
much.
Okay, so cash coming into the business increases cash. We increase owner's equity to represent the increase in equity that the owner paid into the business. Okay. What does it look like on the accounting equation? We've increased cash and we've increased equity. Remember, the accounting equation is assets equals liabilities plus equity. This equation will always be in balance, regardless of the transactions that occur. What I mean by that is, in most cases, it'll be an asset account and either a liability or equity account, typically. Sometimes it'll be two different asset accounts, or sometimes it'll be two liability accounts. One will be going up, the other goes down. It still remains in balance. I'm going to show you what that looks like in a few transactions. Second transaction, we used, of that original $30,000, we used $2,500 of that to purchase supplies. Okay, so the cash goes down by $2,500, supplies goes up by $2,500. Now you might be saying, Dr. B, isn't supplies, also known as inventory, an asset account? And cash is also an asset account. Yeah, you're right, they are. So we debit supplies to increase supplies. We credit cash to decrease cash. So the second transaction, we can see supplies goes up and cash comes down. They're both asset accounts, and all I'm doing is moving it from one asset to another. So what that means is the accounting equation is still in balance. You see? So yeah, in some cases that happens. Third transaction, the company needs to purchase equipment for $26,000. Okay, great, no problem. So we got enough cash on hand to do this. So we debit equipment, which is an asset account, and we credit assets. I'm sorry, we credit cash. So we debit equipment and credit cash. They're both asset accounts. Just as the previous example, the assets remain in balance. Cash came down by $26,000, equipment went up by $26,000. We still have $30,000 in assets, which equals liabilities plus equity of $30,000, which came from the equity investment. Yep. Okay, now for a transaction that involves liabilities. The company purchased $7,100 of supplies on account. In accounting, when you see the words on account, that means either accounts payable or accounts receivable. It depends on the situation. If it's the company making a purchase on account, then it's accounts payable. If it's a customer making a purchase from the business on account, then it's account receivable, you see? So you just have to be very careful when you read the transactions. That's what I'm trying to say here. So we purchase some inventory on account. I debit my inventory supplies to increase the asset. I credit accounts payable to increase the accounts payable. Okay. And so here we see that the accounting equation is still in balance. Our supplies went up, our liabilities went up. Remember, assets equals liabilities plus equity. The accounting equation must always remain in balance. Transaction 5, here we provided some consulting services to a customer. The customer paid us immediately $4,200 in cash for the service. Great. I provided the service, which means I could recognize the revenue once I provided the service. So I debit cash to increase my cash, and I credit revenue to increase my sales, my revenue. Yeah. Revenue, as you recall from the expanded accounting equation, is an equity account. So assets went up, cash went up, 4,200. Revenue, equity went up, 4,200. The accounting equation still in balance. Okay. Here are two more transactions grouped together. Sometimes you might perform what's called a general journal entry. This is where you might affect more than one account, okay, in your double entry accounting. So here we have an example, and obviously they're two separate checks, as you can see. I paid rent and I paid my salaries, wages. Okay. Cash went down because I paid rent and salaries. Okay. I paid my rent. I paid my expenses, my salaries. Rent, expense. Salaries, expense. These are, of course, expense accounts. Expense accounts fall under equity. Okay. Expense accounts reduce total equity based off of the expanded accounting equation. So I paid $1,700 in total cash, 1,000 went to rent, 700 went to my employees. They're two separate transactions that I grouped together. Okay. So here we see I paid the rent, I paid my employees, cash came down, expenses went up, which is a decrease to equity. And we can see that the accounting equation is still in balance. The eighth transaction, here's what happened. I provided consulting services of $1,600. I rented some of my stuff to my customers for $300. Okay, so a couple things happened here. My customers have not yet paid me. It says for credit. Yeah, see, or on account. On account. They paid me on account, meaning they haven't paid me in cash yet. They owe me. So I increase what's called accounts receivable. I debit accounts receivable, which is an asset account. I credit consulting revenue and rental revenue. Okay, both revenue accounts, those are equity accounts. So it looks like this. Debit account receivable, $1,900. Credit consulting revenue, $1,600. Credit rental revenue, $300. Accounting equation still in balance. Ninth transaction. I received cash from my customer later on from that earlier transaction. Okay, for the $1,900. Customer comes in, hey, I owe you some money. There's $1,900. So I debit cash, $1,900. I credit accounts receivable, $1,900 to reduce that customer's account receivable for the money that they owed me. You see? And so both of those, as you know, are asset accounts. So increasing cash, reducing accounts receivable, accounting equation still in balance. 10th transaction. A customer made a partial payment. Oh, I'm sorry, we made a partial payment, the company did, $900 for supplies that we purchased back in transaction 4. We purchased them on account, remember? Now I need to pay some of that, yeah, to be current. So I debit accounts payable. I debit accounts payable to reduce my liability, and I credit cash to reduce my cash. And as you can see, accounting equation is still in balance. 11th transaction. The owner took out $200 out of the company for personal use. No problem. We debit owner's withdrawal, $200. That's an equity account. And we credit cash, $200, to take out the $200 from our assets. So owner's withdrawal came down, cash came down. Accounting balance, this equation is still in balance. So as you can see, we just went through 11 transactions, and throughout those 11 transactions, you can see how the accounting equation remains in balance regardless of what happened. Okay, so the whole purpose of that exercise was to help you to understand the accounting equation through a series of transactions, and that every transaction affects 2 different accounts, and those 2 different accounts affect the accounting equation, you see. And so the accounting equation always maintains a balance. It always stays in balance. So the exercise we also just went through those 11 transactions is what you would do in a general ledger. You're recording those transactions as the month goes on or the year goes on. When it comes time at the end of the month or the end of the year, we need to prepare what's called the financial statements. So as you're recording these in QuickBooks or whatever software you're using, like Excel or whatever, you've gone through all the transactions. Now it's time to prepare the financial statements. Now, as I had mentioned very early on today, is that there are 4 primary financial statements that you need to be aware of. There's the income statement, balance sheet, statement of cash flows, and the statement of retained earnings, also known as the statement of owner's equity. Okay, the income statement shows us the sales, which represents revenue, and the expenses of the business for that month. So revenue minus expenses equals net income. Net income can be thought of profit. It's kind of like profit, similar. Net income is similar to profit. It's kind of profit before we take out any withdrawals or anything like that. Yeah. Net income. So revenue minus expenses equals net income. That's the income statement. That information, net income, gets transferred onto what we call the statement of owner's equity. Because the idea is that net income stays in the business. It's retained in the business. The statement of owner's equity shows us the changes of equity in the business throughout that month or throughout that year. We start with the beginning balance plus any investments plus any net income. If it's a net loss, it would be minus. Minus withdrawals from the owners equals ending owner's equity, ending balance owner's equity. Also known as ending balance retained earnings. And then we could create our balance sheet. The balance sheet represents the balances of all of the asset accounts, liability accounts, and equity accounts, which so ironically happens to be the accounting equation. It shows us the balances of our accounts. You see? So assets equals liabilities plus equity. All of those balances for all of those accounts are on the balance sheet. That's where the name comes from. And then we create what's called the statement of cash flows. The statement of cash flows represents the flow of physical cash coming into and out of the business for three different categories. We have operating cash flows, investing cash flows, and financing cash flows. Operating cash flows represents the day-to-day operations of the business using cash. Cash coming in from our customers and out for all of our expenses. That's operating cash flow. Investing cash flow represents the business purchasing or selling property, plant, and equipment. We purchase fixed assets like property, plant, and equipment to invest into the company, to grow the company. So that's why we call them investing activities. So this is cash coming into the business from the sale of property, plant, and equipment, or cash going out of the business for the purchase of property, plant, and equipment. That's investing activities. And then we have financing activities. Just as the name implies, financing activities comes from things like the purchase or sale of stock, bonds, loans, financing. Yeah? Financing activities. So those are the four primary financial statements. We're going to be talking a lot about these statements over the next 15 weeks. Absolutely. This shows us how those financial statements are connected. And I kind of walked through that exercise with you already. I had mentioned that revenue minus expenses equals net income. On the income statement, net income gets transferred onto the statement of owner's equity. Beginning balance plus investments plus net income minus owner's withdrawals equals the ending balance. That ending balance from statement of owner's equity gets transferred onto the balance sheet under owner's equity. Yeah, you see how it's all related, right? And then the balance sheet is also related to the statement of cash flows. The cash balance on the balance sheet is also the ending cash balance on the statement of cash flows. So that just shows you how the four primary financial statements are all related to each other. So, and as we started the class with is I had mentioned that the reason why we take this class is because we need to understand the financial health of the business in order to help us to make decisions, right? And so one thing that we always do is I try to end each class with a ratio. Ratios help us as managers to understand a snapshot in time the financial health of the business. So this is a very commonly calculated ratio. This one is called the return on assets. It tells us how efficient the business is at using our assets to help us to generate revenue, sales, yeah? And the way that we calculate that is we take our net income, which is found on our income statement at the very bottom, divided by what we call average total assets. The word average in accounting means the average of two. We take the beginning balance of total assets plus the ending balance of total assets, and we divide that by 2. That gives us the average total assets. Okay. And that, my friends, is the end of the first chapter. And I sincerely do apologize for going over time. I know that I said I will try not to do that, and we ended up doing it. And so, again, I apologize for that. I really do. I hope that this was a very helpful lecture for you. I will be posting the recording to this in the announcements, as well as any other type of notes that you might want or need. My goal here is to help, of course, to help you to be successful in this course. And the way that you need to do that is, of course, to complete all of the coursework. So what you need to do by Thursday night is to post your original discussion to the week one discussion forum. And then by Sunday night, you need to complete your LinkedIn Learning Certificate for Excel, your Excel essential training. And you'll also need to respond to two of your classmates in the discussion forum by Sunday night and complete the chapter one quiz. The chapter one quiz is based off of the lecture that we just had. So it's open book, open note. You have 2 attempts on each quiz. And so take your time. You can close it, come back to it. And make sure that it's open and accessible for everyone. There's no timer, so you don't need to worry about that kind of thing. Um, you know, but those are the things I need you to complete for this week. Are there any comments, questions, concerns, or anything at all that burning questions that you might have that I can help to answer at this time? Are y'all okay? You still there?
I have one question.
Is that Sam?
So this yeah. So this Thursday we're not meeting in person?
Correct. Yeah. The way that the course is designed is the premise is we will have lectures every Tuesday, and the class time for you on Thursday is for you to complete the work for the week. Okay? Because I understand that a lot of you have other courses that you're taking, you have other obligations that you need to meet. And so, in order to alleviate that stress from having to do all three, four of these things on Sunday night, I don't want that kind of stress for you. So the idea is that on Thursday, you'll have your original post done, and maybe you might even be able to complete the LinkedIn Learning Certificate and the quiz. So use that class time every Thursday to complete the work for the course. That's the best way for us to effectively manage our time together, because I want you to not feel that stress or that burden every Sunday night. You know how it is, especially if you got a couple classes going. So hopefully that helps.
That's very understandable.
Yeah, Tim, I remember being there as a student, and having that extra time is
Yeah, it's critical. I appreciate
it's critical.
that.
It really is. Yeah.
Yeah.
So especially with a subject as tough as accounting. So
Right. Right. Cool.
great,
Thanks.
great questions. And are there any other comments, questions, or concerns?
Will you be available during those times still in case someone?
Absolutely. Yes, I will be available 100%. Yeah, most definitely. I'll be here.
Thank you.
Great, my pleasure. Okay. Well, first and foremost, thank you again. I apologize for going over. That's how it always goes the first day. It really does, especially because the introductions and the overview and all that. That takes a lot of the time. I just want to make sure that we got through it.
Great information. It's great information, though.
Yeah, glad. I'm glad you think so, Tim. Yeah, and I'll try to make everything each week as relatable as possible. I'll use examples. I'll use my personal experience. All those things. So, I'll try to make it easy for you. So, again, thank you all so much for your time. I sincerely appreciate all of you. If you ever need anything outside of class time, you can email me, call me, set up office hours, text me, all those things. I'm always here. Okay, this is my job. My job is to take care of all of you. So, and again, I'll try to respond as quick as I can. Yeah. So thank you all so much. Appreciate all of you. Enjoy the rest of your night. Again, apologize for going over time. Thank you so much.
Thank you.